Okay, welcome to another video. So today what we're going to be doing is going through a couple of the charts in the latest edition of the weekly macro themes. And this is the flagship product of top-down charts, and what we do in this report is we look across the global economy, global markets, bring you some very interesting, unique global macro insights to help inform your macro view, your overall top-down view. And then we also look across global asset classes and see, what are the key risks and opportunities out there that might be relevant to your portfolio to obviously help improve your risk return experience. And then finally, of course, is to bring you a lot of great charts to help make it real to you. And so we're going to be looking today at the first and the last bit, so global macro insights and some key charts. And so why are we doing this? Just wanted to show you what's kind of in the report, how we're thinking about it, and hopefully generate a bit of interest. Would be great to have you on board as a subscriber. We do look at trials where that makes sense, and so without further ado, let's get into it. So first one that we're going to look at here is what we call the nominal surprise index. So this is what you get if you add the inflation surprise index to the economic surprise index, and these are the ones that are put together by the research team over at Citi. And so what we're looking at here is whether inflation data is generally better or worse than expected, and whether the broader economic data is better or worse than expected. And how do you get movement in these indexes? To the upside, you get movement because people are basically too pessimistic in their forecasts, and the data ends up just coming in sort of normal, or slightly better. The other way that you get it is if the data is really good and even better than what people were expecting, with sort of middle of the road or even good expectations. And so what I believe this is probably mostly is the former case where you have people who've gotten perhaps just a little bit too pessimistic, and then you've had some genuine improvement come through, and I'm going to talk about that in a minute. But you look at this patch here in the chart, the last 5 years, it's really been pretty persistent downside, needed pretty deep in some cases, downside surprises. And when you have that going on that time, it helps sort of force down or cause people to reevaluate their expectations. And so this chart by itself is pretty interesting. It's quite unique, looks pretty good. I guess the other thing I'd add there would be that the other thing that you're seeing going on here is that both lines are actually going up. And so if you saw developed economies only going up or emerging economies only going up, one going the other way, you wouldn't have much faith in it. But when you see both of them going up, it tells you that something's going on there. As I said, it's kind of interesting by itself, but if you move into some of the sort of market metrics, that's where it starts to get a bit more real or a bit more confirmed. And so this here chart is what I call the market brief reflatometer, and if this chart's actually going up at the same time as this one, it just adds to the whole consistency of the story. And so what this chart is a combination of market brief across 3 different key asset classes. So 200-day moving average brief is pretty much a measure of what proportion of countries or companies or components are trending up. So if price is above its 200-day moving average, it's a pretty good indication that the market in question is in an uptrend. So for equities, it's number of countries that are above their 200-day moving average. For commodities, it's a number of different commodities. And for bonds, it's bond yields in this case. So it's the number of sovereign global bond markets where bond yields are above their 200-day moving average. And essentially those are all 3 different things that if they're all going up together, that's something that would confirm that whole idea of reflationary dynamic. And so to me, when you look at this chart and you look at that chart together, it tells you that there is actually it's there in the surprise, it's taking people by surprise, and it's actually being reflected in the markets. And so the final chart that we look at is this, which we call the deflatometer. And so I thought to myself, okay, what is reflation? Well, what is the opposite of reflation? And the opposite of reflation is probably deflation. So what this chart does is it tracks the number of countries where you're seeing negative year-on-year gains, or negative year-on-year changes rather. So for equities, it's the number of countries where their market's down versus this time last year. And so if you look at end of 2015, start of 2016, when you have all those market turmoil issues across commodities, China, geopolitics, you name it, it was probably the worst it'd been in quite some time. Almost as bad as during the Eurozone debt crisis. Even nearly as bad as during the global financial crisis and the dot-com bust. And so the next line that we would look at is the blue line, and that's forward earnings. So this is what analysts are expecting about earnings over the next 12 months. So for that one, the higher it is, the worse are expectations about the outlook for earnings, and the lower it is, basically, if it gets to zero, that means that all countries are seeing improving outlook on their earnings. And so you see that coming down along with the market, tends to move with the market. And then finally you look at the black line. The black line is probably the key one where it really comes home, and because this is industrial production growth. So it's the number of countries that are seeing either expanding or contracting industrial production growth. And so you look at the GFC period, you almost got 100% of countries across the world were seeing falling or contracting industrial production activity. And you look at where it is now versus that period there. First of all, I'd note just how throughout this period you've had almost consistently at least a third of countries have seen contracting industrial production, whereas this period here is much smaller than that. And what you've seen is a big turn down there, and it really has moved with markets, with earnings expectations. I mean, if markets tend to provide a lead on that which they kind of do, you'd expect it to perhaps even get even better in the months ahead. And so you take all these three charts together, and we've had this sort of reflationary surprise, and then that's been reflected in the markets, and then it's actually reflecting some pretty good underlying economic trends here. And so you take those all together, and what does that tell you? It tells you pretty much that the whole thing is genuine, that the idea of a reflation isn't overinflated, that there is actually something to it. And so if you have some investment assumptions that are sort of based on a reflation, then they probably do carry some weight. And anything, the kind of market movements that we've seen across equities, commodities, bonds, they probably have still some way to go, given that it's it looks a bit more genuine rather than just a sort of fleeting, or a if it only was appearing here, you'd tend to fade it. So I'll leave it at that, and if you're interested in taking a look at the report, interested in subscribing, get in touch. I've got the link in the comments, not the comment section, the information section for the video. And so it's quite an interesting, a little bit of controversy in the topic, still probably a lot of debate and questions to be asked. So please put your thoughts or questions in the comments down below, and go ahead and subscribe to the channel, and it would be great to have you join us as a subscriber.